All right, all right, all right. Good morning, everybody. Good morning to you, John Walkup.
Good morning to you, Noah Rosenblatt.
Thank you, sir. It is cold out there. It is chilly. It's me a chilly macro month.
Wasn't it? Wasn't it? I went out to walk the dog this morning. I was like, woo, I could have used a hat, some gloves.
Well, let me tell you something.
Kind of thing.
When you're bald, it feels 10 degrees colder. There should be like a bald index of coldness.
Oh, that's interesting. Yeah.
Because whatever it is for you, it's 10 degrees colder for me. I'm telling you.
Oh, there you go.
So if you ever see a man wearing a hat and it's not that cold, you ask yourself, are they bald? Because it's chilly. Hair is warming, John.
It is. Funny how that works. But yes, it is a very insulating layer.
It's an insulating layer. We're just messing around, guys. We're waiting for a couple people to come on here. But John, let's get going, everyone. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs. It is Monday. You guys are going to get a little macro Monday coming right at you. For those of you that are new to the show, we're going to start out with Manhattan real estate over here, go over a couple of things, monthly things, see where we're at. Then I got a bunch of macro tabs set up over here. I am changing my screen with the hopes that it looks better for you guys. Okay, I don't know. Because
we take the feedback seriously. We're trying to make it a little bit more readable. So if you see Noah staring off vacantly into space, that is normal, but he is also looking at another screen.
That is why I got multiple screens set up. So I feel like a trader. I feel like I'm back in my day trader days. Oh God, those are great. Any NASDAQ day traders in the room?
But this is
right here, Daytech.
Good reminder that this is not
.com.
Financial advice. Do not be day trading this.
This is not financial advice, guys. Please don't start day trading this
stuff. The road to ruin.
And if you do, tell us what you're doing so we can track it. Keep an eye on it.
Or do the opposite. Sometimes we do that.
Sometimes do the opposite. If you guys got any questions, please put it right in the comments over there. We want to hear what you guys have to say. But I want to get going, John. I want you guys to look at the screen I got going on over here. This is 1 month Manhattan. We're looking at supply. We're looking at demand, 30-day, 1321 for 30-day supply. That is supposed to be at, check my notes, 1524, John.
It's a little light.
So supply is coming in tight. It's coming in tight and light after a big month in September. So
yeah, September was over. October's under. So I guess net, they're probably similar. They probably average out to roughly the same. I don't know off the top of my head. But right. It's interesting to see 1 month up, the other month below. So,
Yeah. All right, so we'll keep an eye on that. Contract activity for Manhattan, 896. That is supposed to be at 911 for the end of the month. I have a feeling that is going to bump higher.
I think so. Look, so we're obviously going to have some that come out of the beginning of that pipe, and we'll have to add some to the end of the pipe. But we've had a couple of good weeks now for Manhattan. So I think, touch wood, salt over the shoulder, the whole big works, the whole big, whatever superstitions you got, let's throw it at contract sign because I want to see that over 900. And I'd like to see it closer to 1,000. That would be great, I think.
Yeah, these are good prints. We talked about it on Friday. These are good prints. These are good weekly numbers that are coming in, healthy. You wouldn't expect it. I kind of would have expected with the whole election, like, people calming down, but no, there's deals happening. So I'm curious to see where this closes out. 911 is our benchmark for that. Let's go to Brooklyn. Okay, let's go to Brooklyn. Let's change it up a little. Brooklyn a little bit. Brooklyn. Brooklyn supply last 30 days, 812. That is supposed to be at 1,050 for the month of October. So Brooklyn is also seeing the same trend in Manhattan. It's got to be a thing that's happening.
Yeah.
496 contract activity. That's supposed to be at 636. Now, granted, we don't have data though for Brooklyn. We only go back 5 years.
We're only going back 5 years. So that Brooklyn data is obviously completely overwhelmed. It's overwhelmed, frankly, by the 2020, 2022 fall seasons, which we're just kind of 2021, 20. Those are huge. So those are kind of likely pushing it up. That Brooklyn number, given the fact that the last couple of seasons, especially in Brooklyn, have been a little bit tired, that number is most likely going to come down. But either way you slice it, even if you want to reweight the most recent seasons a little bit heavier and you want on an average, we're still coming in a little bit light in Brooklyn.
Yeah, coming in a little light. Well, we should ask our engineer to take a look at that. Maybe we can exclude that for averages, so to speak. Get a little better read on that. But yeah, that's what's going on in Brooklyn. Let us know any market questions you guys got. Put it right there in the comments over there. We want to hear questions because I'm going to go pivot to macro. Unless anyone's got questions. They don't got questions. I'm moving on.
Oh yeah, please feel free to come. We love the comments. Sometimes there's really great conversations happening there, so we encourage it. What can I say? It's good stuff.
All right. Credit spreads. Everybody loves credit spreads.
Oh, so great. Nothing wakes you up on a Monday morning like credit spreads.
We're going to spend no more than 90 seconds on this, John. All
Let's
right,
go.
as a courtesy for credit spread. This is our canary in
Time's
the coal
up.
mine. We're done. If this line goes up, bad. If this line goes down, good. How about that? Okay, and this is 1 year, guys. I like the 1 year chart. I think it's really representative of what credit spreads are telling us. We had the tariff uncertainty in April, didn't really materialize into anything, came right back down. And then about a week and a half ago, we had a little bump, little hiccup, little regurge kind of thing. Came up, but we held it back. Took a little Tums, held it back.
Yeah.
Coming back down. I don't see anything. I mean, look where we are.
Yeah, I like that line. So let me tell you how I view this. And first of all, I love to joke about credit spreads because sometimes they're extremely boring, but that's also very important. So here's what I'm looking at on that 1 year chart, especially with your little line going across there. And that's that you can kind of see the first third of the year there, right? Basically a flat line. Then we jumped up for Liberation Day for the tariffs, for all that news. And then we kind of slank back down. We had a nice downtrend going from that. We got a little bit below that line and we're kind of coming back up. So we've kind of broken that downtrend. No, it seems like we're back in the going steady. So we're almost like back to where we were beforehand, which is not to say we're out of the woods, whatever you say. Whatever. Either way, my point is that we've kind of come back to the normal that we were before all of the inflation stuff. So it's nice to see that we kind of reverted, but that downtrend seems to me to be broken and we're kind of going sideways here.
Yeah, I see low credit spreads, risk on. That's what I see, because this is a risk on, risk off market signal. That's what this is, risk on, risk off, and I see risk on. So stocks keep going higher. That's it. Until it doesn't. Well, you've been saying that for a long time.
My own thoughts.
So, yeah, I know.
All
right, no warning sign in credit spreads. Would you agree there's no warning sign in credit spreads right now? Put it that way.
That's a great question. And I would say yes, but sometimes the lack of a warning sign is a warning sign. Bum, bum, bum. How about that plot twist? So yes, that does concern me. Ooh, the sound effect.
I just got gonged.
You had that ability.
I didn't know either. But now that I got him, I might click a couple more things. All right, let's go to Fed Fund futures. We're trying to have fun, guys. We're trying to have fun here. That's what we're trying to make learning fun a little bit. All right, Fed Fund futures.
Hey, what credit spreads are their own fun.
Yeah, maybe. I don't know. I think 10 people logged off during the credit spreads. Anyway, let's go on. Fed Fund futures, guys. Fed Fund futures is our guide to the interest rate market. It is the bond market. It is what the market expects the Fed to do on future meeting dates. You can see future meeting dates right down here. It goes all the way to September of 2027. Guys, you are forbidden to look more than 2 meetings ahead if you listen to this show at all. That's it. First 2 meetings. That's as far as we go.
We have a meeting this Wednesday. That's the next meeting.
Yeah.
And don't you think it's interesting that it's not 100% or 99%? It's like 96. Like,
it's convincing enough.
It's super convincing. But what are the people who are not convinced? What are they thinking about? So, it's like Dumb and Dumber.
Well, they want to.
There's a chance.
Do no cut.
Yeah.
But not the 0 for 2 cuts. So let's just go over.
Would you fight that? I wouldn't fight that.
I wouldn't fight it. There's a comment in there, but let me just go over really quick what's happening over here with the Fed Fund futures, guys. Here's how you verbiate this. According to the Fed Fund futures, predicting the Fed funds rate in the future, that's what it is. We are here. Next meeting is on Wednesday. 96.7% chance of a 25 basis quarter point cut. All of these are quarter points. And then the next meeting, December, 96% quarter point. And then that's it. Stop right there. You got to cut over here. You got to cut over here. You got to cut over here, but it's in the forbidden zone. It's below the line.
I like that idea a lot. The forbidden zone. Because you're absolutely right. After that point, really, these numbers are essentially meaningless because there's so much stuff that can happen between now and then that it just traders are making these bets because they have to, not because they want to. So
there you go. Gong show. That's what I'm talking about. We're gonna try to make this thing a little fun. That's what we're gonna try to do. So yeah, that's what you guys need to know. 2 cuts, October and December. That's priced in. So when we go to mortgage rates, mortgage rates, dark blue is conforming, light blue, jumbo, Johnny. I don't know what that is. Look at that.
Yeah, that's a little bit of a spike in the jumbo rate. Now it's obviously a 1-day spike, and it'll it'll probably revert. I mean, just given the trend from the top left to the bottom right, I mean, it's a downward trend. You can see it. So the question is, are we just sort of reverting back to that trend line, which is probably a little bit higher, maybe went a little bit high, but it's interesting to note that at the same time, you look at the conforming line, that's the dark blue line. It's kind of going sideways for the last week or so. So we had some good downward movement. They're in a good place. Let's hope we can get a little bit more downward movement. And one of the things, by the way, we're talking about just in general is bringing on a mortgage professional to talk about what they see in the market, what their offers are, and this kind of thing. So we know you guys are interested in that. We're working on bringing that to you guys as well.
That's a really good point. We have a question that might not be a rates question, and we're on the rates segment of the program, but what are your best tactics for tackling client concerns that New York City real estate is no longer an appreciation play? That's a really tough question. You want to take a second and discuss this?
I would argue that for most of New York City real estate, it has not been an appreciation play for at least a decade, right? We've talked about the lost decade. When you look at median price since 2015, we're basically at the same point. It's still cheaper than renting, I suppose, but at the same time, like, no one's making a killing buying and flipping. So yes, certainly there are properties that have appreciated in value, in some cases significantly, but I think that's more of an exception than the rule.
Well, there it is. Okay, guys, I went to the chart room. Okay, right over there. Resale condo price per square foot. Click on the max button, and this is what John was talking about. We didn't do anything for a decade. You know what's interesting? You think about what we did from 2005 to 2015, that decade. It's like we went up for that decade, and then 15 to 25 sideways. I mean, I wonder what 25 to 35 is going to be. You know?
Yeah, I think this is one of those markets where you really have to have you think long term is like 3 to 5 years. No, you have to have sort of a decade view of these things. You have to have a long holding time, and you have to be patient, really, to really be in this market for appreciation. But at least for most people, you're looking at a lot of break even. Some people are losing a couple percentage when they sell because they bought at the high and they may have overpaid. So for a lot of folks, it's less about appreciation. It's more about a store value, which I suppose is a sign of a mature market. But we'll see.
Yeah, I was going to suggest either a long-term hold play, 7 to 10 years, try to catch the next upswing. We move in decades, these cycles. And the second thing I was going to say is try to leverage the rental market if you can. The rental market's where it's at. The rental market's been going up. You're still probably going to lose a little money on it, but like the rental market's going to probably do stronger than the sales market for the next couple of years. At some point, there might be a little switch going on. You know what I'm saying? So interesting. Rates going up in the jumbos. That's all you need to know. 6.5, but they came down a lot. So this looks like regression to the mean. Conforming still good. Rates are still generally good. I think we got a rate bump.
That's why we want to bring in like a rate professional, because it's so interesting when you talk to different people at different banks, like what they're offering because I'll be honest, Noah, when you have a personal relationship with a mortgage broker, obviously you can usually get rates below the headline published rates. So it's always nice to know what those options are, where you can get them, and what it might take. So FYI.
Okay. Guys, we'll take a quick look at inflation right over here. This is the stuff that drives rates, right? Inflation in the economy. If I had to summarize, like, what the hell's going on out there, because I mean, it's really conflicting. Inflation's like, it's way down. All right, you can see it's way down, but it's still higher than the target. Okay, it's like lingering. The labor market is overall historically strong, but it's starting to go the wrong way. It's starting to show cracks. So it's like, there's these varying things. That's what's going on. And you can see from the inflation chart right over here, the blue is CPI, the orange is core. You know, there are upticks going on over there, but it's just lingering around that 3% level. So
yeah, but it's working its way back down. That's the important point, right? So obviously there's a huge spike and it's starting to come back down. That's great, but it's, again, kind of like that's a little bit of sideways action here. But this to me gives cover for more rate cuts versus hikes.
Right. Robin, can we try to reframe that condo buyers overpaid? They paid what the market was dictating at that time. Yeah, not to say they overpaid. I mean, some situations they overpaid. Like I see some situations where they overpaid in some situations. But no, I mean, this is what the market is. what the market is, right? It does what the market wants. So, I mean, it's the only problem is we're trying to measure where the market has gone over time. And, you know, a lot of people that paid X 10 years ago are getting X minus X percent or Y percent today.
Yeah.
And that's the problem.
No, it's I would say this is a fantastic point about, look, the market is what the market is at any given point in time. So you're right. You're not overpaying. You're basically paying market, but sometimes that's a very frothy market. And so overpaid is a sort of a shorthand for that. But yes, you're absolutely right. You're paying market price. That's why this is why I'm going to get back on my soapbox. Like we do this advisor service. We do all this stuff. We got to let the market work, people. And this market will work. If you get it priced right, the market's going to work. Now, obviously, when you have a frothy market, the market sometimes works too well, right? You get that price pushed up. From the seller standpoint, that's fantastic. From a buyer standpoint, paying a little froth, which is going to subside when the market cools. But generally speaking, the market works really well if you let it work.
Yeah. And look, I think that with price action going sideways, I think Noam Newman mentioned this. I think is a really good point. Is like when the market goes sideways for 10 years, while the housing market outside doubles, right, up 100% over the last 10 years, it's got to be something with policies local to the market, or it's got to be demographic changes local to the market. We had both. That's very important you guys to understand. We had both, right? I mean, like the 2019 rent regulations in and of itself impacted our market from an investment standpoint. So, and then we deal with the pandemic. We're coming back, but the damage was done and we're kind of working our way back, you know? So we'll see what happens. Stagflation. Yeah. Right, Johnny? Isn't that what inflation, economy, basically stagflation?
Well, I think these are the Fed has two concerns, right? They want to boost employment and they want to keep prices stable. And you can fight one of those battles and then the other one's going to slip through your fingers. So when you lose control of both, that is stagflation. So that's really what the Fed's trying to fight right now. And at least the cover of lower inflation is going to give them some room to keep rates low and perhaps lower them. But if that number should start to change, if CPI should start to tick back up materially, well, then suddenly the game has changed. That's a rate hike scenario, in which case all bets are off compared to what we're seeing right here on this board.
Well, if that happens, then all these blue boxes that are going like, let's just follow the curve here, guys, right? All of the blue box, that line will go to the right. We'll shift that way in that case. And mortgage rates
spike
will go up at the same time.
Mm-hmm. Taper tantrum is what they call it.
Yeah, you know what this is? So like we always talk about the market's pricing in, the rates are pricing in. This is your real-time pricing in table. You're literally watching the market price things in before the cuts even happen. Okay.
True.
Okay. The stagflation. Yeah. I mean, I think that's why there's only 2 cuts here. They're kind of stuck. They can't go too much. So we'll see what happens. All right. Where are we here? I lost track of my whole thing. Owner's equivalent rent. I only bring this up. This is national. Okay. But owner's equivalent rent. This is one of the measures that we do for CPI. CPI, it's a big part of CPI, owner's equivalent rent, and it's been going down. So that tells me is that over time, the CPI, the inflation measure that we just looked at, might have a little downwards pressure on it because this big component, which is like a third or something of it, some big chunk, is going down. So that's one element. Not in New York City, it's not going down, but in nationwide it is.
Yeah, no, it's a big run up. And
it's a big run up.
It's come down.
We're still above
quite a way.
Before, though. We're still above it.
I know.
So.
I know. So that's probably why you're seeing rates where they are now, and then we're not back at 3.5%, 4%. We're still up there.
Right. Okay. And finally, guys, just to guys macro you guys out. Can you see this? Okay. Do I have to make this a little
more
bigger?
Macro? Bring it on.
I'll tell you what you're looking at here. You're looking at this two national housing slides here. The National Association of Home Builders. Okay, this is the Wells Fargo. What is that, John? The Housing Market Index, HMI.
Housing Market Index.
Yeah. Housing Market Index has components of that index. Okay, and basically you're looking at since the pandemic. All these 4 charts are like the last 4 years. Okay, think about it that way. Builder confidence, it's been down, but it's ticking up. Okay, look at that last right, ticking up. Present sales down, but ticking up. Okay. Sentiment for the next 6 months, it's a survey of home builders down, that's starting to go up. traffic of prospective buyers based on reports from the home builders down, starting to tick up. We're in October. So I have to ask myself, is there a seasonality element to this? I don't know. What's the national housing market season? It can't be winter.
Well, I think a lot of markets actually have a stronger fall season. Like they'll have a
then spring
summer,
or
fall
summer
season. Yeah, some markets don't really have they have a spring season, but mainly it's focused around fall purchase, like into summer purchases. Think that thing, get the house and all that stuff. It's settled before school starts. You know, that's kind of the primary season, and sometimes spring is a little bit of an afterthought. But our market's different. We're a spring market.
I did not know
in
that.
most cases.
Yeah. So I was going to say, either this is seasonal, it's a seasonal thing, it happens every single time this time of year, or is the market trying to come back? Is rates coming down, starting impacting the market? I don't know. It's a reminder that the housing market across the country has been in a tough market for the last 4 years, 3-4 years. It's mature in this down cycle. At some point, it's going to come back. Right.
I mean, this is what makes New York City and the Manhattan and Brooklyn markets especially so different than the national markets, because when you look at these, most of all these indexes, I mean, I would say a solid super majority of homes are trading with mortgages, right? That's usually, especially with the home builders, most of these buyers are getting mortgages to buy these homes. So this is heavily driven by what mortgage rates are, and that shock from rates going from essentially free money to 7% over the span of 6 months really broke things, as you can see. That's what that sharp downline is. So it takes a while for that market to digest that, especially as rates start coming down, buyers start re-engaging. We saw something similar happen in the financing dependent sectors of Manhattan and Brooklyn, but the luxury sector during this period was basically marching to its own drum. And it's very interesting to understand how that dynamic, which is a big part of both of these markets in our city, is acting. So you really have two markets under one roof here. So
yeah, interesting.
I'm hopeful that the financing market comes back strong.
Yeah, me too. All right, well, we did it, guys. We made it. Got back. Let's circle back to Manhattan real estate. Hopefully our brains aren't too fried here. We talked about this on Friday. I want to put it out there again, see what you guys think. We like to look at price cuts in terms of a schedule. First price cut, second price cut, third price cut. This is just pure stats. We're just looking at the last 90 days of contracts signed, and then of those bucket of listings, how many of them cut the price and when, and what was it? So what I thought was really interesting here is that you got your average price cut. Look at this column right here. You got your average price cut for all Manhattan studios, 1 bedrooms, 2 bedrooms, et cetera, et cetera. And we're all trying to beat the average. If you can get away with getting your contract, can I draw on this? No, I can't. If you can get away with getting a contract signed right down here, right, after the first price cut and not getting to the second one, you beat the average. So it's okay to do a price cut. And if you do it, do a notable one. Too many people do, 2%, 3%, doesn't work. Then they got to do a 5%. And that's what kills them. You know what I'm saying?
Are you asking me to get back on my let the market work soapbox? Because I will get up there and I will preach it from the mount.
Yes, I got no regrets over here.
What's interesting is when you look at those buckets, right? The colored buckets, right? You have the first price cut, second price cut, third price. We refer to it as price adjustment. I think it's a kinder phrase.
Adjustment.
But you look at what those are, and if you sum those up, now obviously the sum of those is not going to be the entire price cut, but the idea is that if you have to go through 3 price cuts, the penalty you're going to be taking dwarfs what it would have been had you just taken the big, get to the market first. So in the first instance, if you're just looking at all Manhattan, right, the average is around 7.4%. If you have to go through all 3, you're actually looking at something closer to like 15-16% price cut. So that's a big change. So to your point, Noah, you're absolutely right. You want to beat the average, and how do you do it? You get to the market and let it work. Okay, off my soapbox.
Yeah, you guys can take a screenshot of this and use it. This plus, let me go back. Bear with me. This plus this chart, this pricing penalty chart right over here. We loaded up from Manhattan. Okay, I think scare your seller straight. Right? Because you're showing them this and you're trying to tell them, hey, the average is 7.4. If we can get done below the average, we're ahead of the market. If we're above the average, we're behind the market. Let's try to be ahead of the market, right? You could make some assumptions right over here. But then you go here as well. to this pricing penalty chart. And let me just explain what this chart is for those of you that may not know. Take a look at the bottom line. I'll get rid of that for ease, okay? We looked at all the closings, okay, all the closings, and then we took out the closings that specifically took less than 60 days to get a contract, right? That bucket of sales, we looked at how much the discount was from original ask. It was 1%. So these guys sold quick. We could derive why, but they sold quick, under 60 days. Sellers got 99% of their ask. 99% of their ask. When we look at sales that took more than 120 days, okay, and look at that bucket, they took 10% negotiability. So we're just trying to show a correlation, Johnny, between pricing right, the market reacting, the market doing what the market does, right, and discount. Is there a relationship between pricing right, selling fast, and discount? And the answer is yes. So you show them this, and you're like, number one, we want to be those people that are signed the first 60 days, so let's price it consciously, right? And number two, here's that penalty. You show them that penalty, they get a little worried. Maybe they change their strategy.
Yeah, and by the way, you can do this for Manhattan and Brooklyn. We're showing the Manhattan schedule here. The Brooklyn one we did on the Friday episode. You can download that on the site in the oh my gosh, you have it. Look at you. I didn't know that.
Unbelievable.
I thought you were unprepared, but I was unaware.
No, I put it up there. You said we got Brooklyn peaks here. We got to go show what's going on in Brooklyn. But here's Brooklyn. We don't have the days, but here's Brooklyn. But it's basically the same concept, except for the studio.
Similar pattern. Similar pattern. Yeah.
Very similar. Yeah. Okay.
Good stuff.
That's all I got. Questions? Final questions for Johnny Walkup? Charts?
Or
anyone?
Noah.
Johnny charts? We're almost done here, guys. We're going to hang out for another 10 seconds. No? Wednesday, guys. Not Tuesday, but Wednesday. Me and Johnny be sitting down, similar rooms. Ask us anything. Hopefully, you guys got questions.
It's going to be
talk about anything. Open table.
It's going to be a cage match of information. We're going to be in the same room answering questions.
Ask the stuff that you don't even think we want to answer. Like I anything. Like there's no holds barred on this thing. So hopefully we just have an open conversation. Hopefully you guys have questions. Join us for that. Outside of that, I got nothing. I'm done.
Well, I've got something, but
oh no.
Nothing really worth sharing. So I thank you.
Okay. All right. I don't see any questions. So with that, Johnny, thank you very much for. Is the chart in the chart room? Which one? This chart pricing penalty is in the chart room, and you can get that from Manhattan and Brooklyn. Okay. If you click on the chart room over here, and on the left side, scroll down, pricing penalty right over there. Okay. If you need an extra trial, you need a 7-day trial to try UrbanDigs because you don't have access to this, email me, noah@urbandigs.com. I'll give you a 7-day trial. Try it out. The 3 price cuts. No, the 3 price cuts we did on Friday. So the way you get that is right over, wait for it, right there is where that should be. Okay. All right, guys. Good luck out there. Hopefully strike while the iron's hot, while the market's good. Go ahead, John.
Do you want to just describe how we pulled that data for the chart room? For the price cuts. Basically what we did is there's a little button there that says infographics. And in infographics, you go into price cuts.
Infographics.
Yeah.
Price
go down
reduction.
To price cuts, price reductions.
Next.
And we just set it to all Manhattan. And then we just went through the different bed counts to kind of get a sense for what that is. And we just put it together. So that chart is not in the chart room, but it is in the infographics. You can hyperlocate this if you want. Sometimes the data gets a little bit too granular to be useful.
Don't get too granular in your data, guys.
Don't get granular.
Yeah. Get a little more widen out, get some more chunky data in there to say have some more meat on the bone.
Sand in your shorts. You don't want the granularity. So just zoom out, get the data you need. Good stuff.
All right. Thank you, John Walkup. I am Noah Rosenblatt. Thank you, guys. Good luck out there. This has been Macro Monday, and we'll catch you guys next time. Cheers, everybody.